Now, as we know that, for every law there has to be an act, and you know the procedure how the act is made. Initially, whenever the government wants to levy any taxes, want to make any law, government basically comes up with firstly with the discussion paper. After discussion paper is basically circulated with the different segment of the society, and suggestions are taken up by the government. Then it is basically a bill is drafted. Once a bill is drafted and it is passed in the parliament in both the houses, and assent of the president is given, and once it is notified, then it becomes an act. Similarly, as far as income tax is concerned, for that also we have an act which is called Income Tax Act. Income Tax Act 1961. Now, this law, Income Tax Act 1961, has to be studied along with the rules framed by the government, which are Income Tax Rules 1962. Now, rules along with the law and along with the different circulars and notifications which are given by the Central Board of Direct Taxes are to be considered for the understanding of the entire law. Moreover, we also know this thing that the rates of the tax are not given under the Income Tax Act. The rates of tax are provided by the government on the year-to-year basis by the finance bill. And once this finance bill, as you know, is nothing but the budget which is given by the government every year in the month of the February. Now, once this finance bill gets passed, it becomes Finance Act, and it provides the rates of tax for the different assessment years. Now, for example, if there was a budget in 2013, the budget which was presented by the government in 2013, once that got passed in both the houses of the parliament and got the assent of the president, it became Finance Act 2013. Now, Finance Act 2013 gives us the rates of tax which are relevant to the assessment year 2014-2015. Rates of tax are always provided by the government 1 year in advance, so that the concerned person can plan for their income and for the taxes in advance. Even before the previous year in which the income is earned is started, the government provides with the rates of tax. Now, take an example. In 2013, let us say if the budget was provided in month of the February, the financial year 13-14 would be starting from 1st April 2013 and it will be ending on 31st March 2014. Now, this is the financial year where we will be earning the income, and its relevant assessment year will be 2014-2015. So even before the financial year 13-14 starts, government would provide you with the Finance Act wherein the rates of tax would be mentioned, and these rates of tax would be with reference to the assessment year 14-15, which will be taxing the income of the financial year 13-14. So the rates of tax are provided by the Finance Act, and these rates of tax are 1 year in advance. Now let's move on from this topic. Moreover, in the Finance Act, not only the rates of tax are provided. Now the Finance Act Part 1 has got four parts to it, and the 4 segments to it. Basically, they gives us firstly the rates of tax which were applicable to the last financial year. First part would be covering that. Second part would be having the rates of tax which would be applicable to the forthcoming financial year. And third part would be covering the rates of the TDS, etc., which would be applicable to the salary and certain other things. And the fourth part of this Finance Act would be covering the computation of the net agricultural income. So this Finance Act have different segments, and to be aware of all these things, students should try and see the Finance Act which have been which they can search on the net, and they can see through them to have the greater understanding of the subject. Now we know now that what are the things to be studied to cover the entire income tax law. One is Income Tax Act, number 2 is Income Tax Rules, number 3 is circulars and notifications, number 4 is the relevant Finance Act, And there's one more thing which we can see, the decided cases by the tribunals and the courts on the various issues. If we sum them up, together, then we can have the clear understanding of the tax laws. Now, let us just discuss the structure of direct taxes, income tax portion, which we have to study. Now, initially, I told you income tax is the tax on the person. Now, person, who is person? Person under the Income Tax Act, you have already studied, covers the 7 parts. Number 1 is an individual. All these 7 parts which I'm saying, all these are the persons. They have been divided into the different categories to administer the tax on the, in a better way. So the first part of the definition of the term person includes an individual. Individual means a human being. That is a natural person. Number 2 is Hindu undivided family. Hindu undivided family, its definition has to be taken from the family law because it has not been defined under the Income Tax Act. But we know from family law portion that Hindu undivided family stands for a family wherein all the male members come from a common ancestor. That means they have lineally descended from some common ancestor. And HUF also include their wives and their unmarried daughters. Now, as far as taxation of HUF is concerned, HUF is treated as a distinct person from its members. Income of its members would be taxed separately in their hands as an individual, and income of the HUF would be taxed in the name of the HUF as a separate or distinct entity. Now, the third is the company. Third person is company. Fourth person is association of person or body of individual. Fifth is local authority. Sixth is we have artificial juridical person, right? So this way we have divided the definition of the term person, and we have got different types of person, and for their taxation different laws have been made under the Income Tax Act for their taxation purposes. Now we know the tax is imposed on the person, and tax is imposed on the income of the person. Which income? Answer lies, tax will be imposed on the total income of the person. Now, what is total income of the person? Total income is also known as taxable income. Now, how do we derive the total income or taxable income? Total income or taxable income, to derive that, under the Income Tax Act, income of a person have been divided into the 5 different categories under Section 14. Now, these 5 different categories are also known as 5 heads of income. Now, 5 heads of income, that means a person can have the income from business, a person can have the income, working for someone, as a salaried person. Person can have the income by dealing into the shares, securities. A person can have income by way of, putting the money into banks and having the interest income. So there are infinite sources of income. All these sources of income have been divided into the 5 different categories, and these are known as 5 heads of income. Now, the first head of the income is known as salary. Salary head of the income would cover the income of a person which is derived by working for someone under a job. Now, question arises, which income would be included under this head? Now, I am going to give you 2 questions. If these 2 questions are satisfied, then you would include the income under that salary. You will ask yourself these 2 questions, and the first question is there a relationship of employer and employee between the payer and pay? If there is a relationship of employer and employee, that is a master-servant relation between the payer of income and the receiver of the income. If there is a master and servant relationship or employer-employee relationship, that satisfies our first question. But this question alone is not sufficient. Second question is also to be satisfied, to include an income under the head salary. Now, the second question is, the payment by the employer to the employee is due to the employment or due to some other reason. If the payment by the employer to the employee is because of the employment alone, then only we can include the income under that salary. So the two conditions, first is there should be an employer-employee relationship. Second condition, that the payment must be because of employee's employment with the employer. That means it must be because of employment. Take an example. Employer and employee are childhood friends. An employer, because of his love and affection towards his friend, gives him a gift on his birthday as a friend rather than an employer. However, in real life they are employer and employee, but the gift is given by an employer to the employee as a friend, not as an employer. Now, can we tax this income under the head salary? Answer is no, because the first condition is satisfied, that the relationship between the payer and payee is of employer and employee. But this payment is not because of employment. This payment is just because of friendship between the employer and employment, which is childhood friendship. So this does not satisfy both the conditions. Therefore, this income cannot be taxed under the head salaries. Now, similarly, you might have studied so many other examples also. Now, let's move on to the second heading or second head of income, which is called income from house property. Now, question arises, what is taxable under the head income from house property? Now, is it the rental income? When we let out the property, we receive the rental income. Is it that income which is taxable under the house property? If this is so, then if some house is not let out, then would that be taxable or that would not be taxable? Now, answer to the question is that it is not the rental income which is taxable under the head income from house property. It is the notional income or hypothetical income, or it is the presumptive income, which is known as annual value, is taxable under the head income from house properties.